been analyzing financial markets for 2 decades. Grant Wozlik now contributes ideas and research to Weiss Ratings.
Grant, tell us about your background in the investment world and where it all started.
Shortly after college, I basically began a short career path as a stockbroker, worked for a discount broker where I headed up the margin department. And then I moved over to the trading desk and supervised some traders, moved out to Arizona to work for Charles Schwab. Uniquely there, I was the first ever outside hire into a specialized risk department. I came back to Pennsylvania, ended up going to work for a large RIA, registered investment advisor, wealth manager for short. And we had a really small firm, but a lot of money under management, over $1 billion, and did really well for our clients with a conservative approach.
He then started writing for financial publications.
You're a big fan of diversification in portfolios. How should investors approach diversification right now?
Most investors would do well having a diversified portfolio. And that might sound boring, but I mean, having exposure to large cap stocks, having exposure to small cap stocks, having exposure to bonds, even though everybody hates bonds lately, although rates have been rising, so that sentiment's going to turn. And a starting core block could be low expense ratio ETFs that have broad coverage of the markets.
And he's big on finding alternative investments outside of stocks and bonds.
For almost my entire history, probably I would say once I got in the industry, maybe 5 years or so, I was just interested in finding exciting new ideas that could generate very good returns and do it conservatively for the most part. Probably around 2017, I first started researching and writing about Bitcoin, blockchain, other cryptocurrencies. Cryptocurrencies are not conservative, obviously, but I believe in position sizing small with cryptocurrencies so that they're not affecting your total net worth at the end of the day if they would go to zero. I believe Bitcoin as digital gold has staying power. Ethereum has staying power due to its smart contract ability.
Right now in the US, there's BITO, a Bitcoin futures ETF, but there isn't a spot ETF based on the actual price of Bitcoin.
I think when that comes, that should help the market out, and we should see a lot of money come into that ETF.
He sees consolidation in the future of the thousands of cryptos in the market now, with opportunities expanding around the metaverse.
I think it's got a huge reach. There's constant announcements. A lot of the large companies are having to go towards the metaverse, or at least they're thinking about it, right? Whether it's Nike, whether it's Disney, even PLBY Group, the old Playboy Group. So a ton of companies doing stuff there. Been a lot of talk about music rights going through NFTs and all kind of tied to the metaverse in a way. There's some really interesting projects out there. I think the metaverse has a ton of room to grow. I think it's still early days for crypto in general, and certainly for things like NFTs in the metaverse, but it's moving at a pretty rapid rate.
He believes in a variety of asset classes that have been around for decades, offering high returns with low volatility.
The fractional investing component allows the everyday investor, where it's not just reserved for ultra high net worth investors or accredited investors, to be able to get into those asset classes that fit in the alternatives bucket, where you can invest in private companies, where you can invest in private real estate, where you can invest in fine art, where you can invest in fine wine, where you can invest in collectibles, where you can invest in farmland.
Farmland, for example, in this index shows an average annual return of 11%.
And so I think if you study a lot of those alternative asset classes that are now offering the fractional investing component, you'll see that some of them have generated monstrous returns like cryptocurrencies. Other ones have generated more conservative returns, but they don't have the big downturns that the stock market will have. And they perform very well over the long term. So I think that kind of just pitches towards that safety angle. They can actually reduce your risk in the portfolio and increase your return, which is magic in the world of investing.
And you'll learn more about them in upcoming issues.
Investment analyst Grant Wozlik, so great to speak with you. Thank you so much for making time today.
Thanks for having me.